Hello, and welcome to our online What's New Municipal Law 2020 presented by the Bureau of Municipal Finance Law of the Division of Local Services. This is part 2 of our two-part What's New presentation. In part 1 of the presentation, we discuss new legislation related to municipal finance law. In part 2, we will discuss court and appellate tax board decisions relevant to municipal finance law and some other interesting municipal decisions. This presentation will be broken into 4 segments: property tax cases, tax collection and public employment cases, finance and land use cases, and other interesting municipal decisions. We're going to start with recent decisions related to property tax issues. The first case is Beacon ORED versus Assessors of Worcester. It's an appellate tax board decision that was issued on May 14, 2020. This was a valuation appeal by the taxpayer to abate fiscal year 14 and fiscal year 16 taxes on an affordable housing development. It involved multiple non-contiguous parcels improved with affordable housing units. The subject properties were organized as a single development. They were supported by a common financing program which offers financial incentives to developers to create affordable housing. The financing program applied to all the units at the subject properties. Additionally, the units were subject to rental restrictions. Effectively, the incentives and restrictions applying to the whole development curtailed the ability to sell any parcel individually. The assessors had used a combination of a comparable sales approach and an income capitalization approach to valuing the properties. The Appellate Tax Board rejected the use of comparable sales because individual sales were not feasible in this case, given the common financing and restriction scheme linking the subject properties. Instead, the Appellate Tax Board agreed with the taxpayer's use of an income capitalization approach to valuation. But the Appellate Tax Board accepted the assessor's position that the taxpayer's capitalization rate was too high, as it didn't include the benefits applicable to public financing incentives. The Appellate Tax Board also determined that the taxpayer did not meet its burden challenging assessor's value of the parking lot and rejected taxpayer's claim the parking lot had no value. In the end, the Appellate Tax Board's lower cap rate on taxpayer's valuation resulted in a higher valuation of the property and a lower abatement for the taxpayer. The next case is Brooks versus Assessors of Worthington, another Appellate Tax Board decision. This decision is related to the Appellate Tax Board's jurisdiction on appeal. In this case, taxpayer Mark Brooks owned 2 parcels in the town of Worthington. The first and larger parcel contained 10.45 acres of land and a single-family house. It was valued at $226,800 and assessed a tax in excess of $3,600. The second parcel was much smaller and vacant and valued at $52,000. It was assessed a tax of $838. The tax collector of Worthington, a quarterly billing community, sent the tax bills for the 2 parcels in December 2015, which were due and payable in 2 installments on February 1, 2016 and May 1, 2016. The taxpayer paid the tax bills for the larger parcel late and incurred interest. He paid the bills for the smaller parcel on time. The taxpayer then filed timely abatement applications for both parcels with the assessors, and the assessors denied the applications, and the taxpayer appealed to the Appellate Tax Board. Under General Law, Chapter 59, Section 64, timely payment of taxes over $3,000 or payment of an amount at least equal to average tax for 3 preceding years without incurring interest is required to pursue an abatement appeal. Note: under the Municipal Modernization Act, effective November 2016, this statutory amount increased to $5,000. However, that increase did not apply in this case. The assessors urged the Appellate Tax Board to dismiss the appeal on the more expensive parcel, since the taxpayer's late payment of the tax bills eliminated the jurisdiction of the ATB. The ATB agreed and dismissed the appeal on jurisdictional grounds. Regarding the less valuable parcel, parcel number 2, the taxpayer satisfied the requirements for ATB jurisdiction by timely paying these taxes. However, on the scheduled day for the ATB hearing date, the taxpayer did not appear. So, the assessors promptly filed a motion to dismiss the case for lack of prosecution, and the ATB agreed and dismissed the appeal under its own rules. In this case, the ATB ruled in favor of the assessors on both cases for jurisdictional reasons and for not following ATB procedural rules. The next case we're going to look at is NHP Properties versus Assessors of East Longmeadow. The decision in this case was issued on June 8, 2020. There were 2 issues in this fiscal year 18 tax appeal. The first was jurisdictional. The second was whether the property was overvalued. But to get to the overvaluation issue, the Appellate Tax Board first had to decide the jurisdictional issue. After the fiscal year 18 tax bill was issued, the taxpayer timely paid the tax and also timely filed an abatement application on January 30th with the assessors. The assessors took no action on the application, and so it was deemed denied under the law, which we'll talk about in a minute. The assessors issued an abatement denial notice on May 2nd, 2018, which incorrectly noted that the abatement application was deemed denied on May 1st, 2018, and that the taxpayer could appeal to the Appellate Tax Board within 3 months of May 1st. Under General Law, Chapter 59, Section 64, assessors have 3 months to act on an abatement application or it is deemed denied. Section 63 requires notice to the taxpayer by the assessors within 10 days of the assessor's decision on the abatement application or the date the application is deemed denied. In this case, the abatement application was filed by the taxpayer on January 31st. The Appellate Tax Board determined that 3 months after January 31st was April 30th. The assessor's notice had the wrong date, May 1st. It should have been April 30th. Because the assessor's notice had the wrong date, the ATB reasoned and held that the notice was defective, and because the notice was defective, the taxpayer then had an additional 2 months under Section 65C to file a petition with the ATB for permission to file a late appeal. The taxpayer did file the petition, which was allowed by the ATB, and the taxpayer filed his appeal with the ATB on August 1st. The ATB found it had jurisdiction to hear the taxpayer's overvaluation appeal. The assessors had valued the taxpayer's nursing home property using the cost approach, replacement cost with allowance for depreciation plus land value. Because a nursing home generates income, the taxpayer argued that the income approach to value was a more fitting way to arrive at fair cash value. But the taxpayer presented its case through its attorney and offered no expert testimony. The ATB pointed out that property valuation is a proper subject for expert testimony, and in particular, the income approach requires an expert. There must be reliable estimates of vacancies, and the capitalization rate must be determined from financial data. By offering no expert testimony, the taxpayer failed to meet its burden of proof that the assessment was incorrect. So, although the assessors lost on the jurisdiction issue, the ATB decided for the assessors on the valuation issue. The next case is United Salvage v. Assessors of Framingham. This case is an appeal to the Appellate Tax Board regarding the Clause 45th tax exemption. In Framingham, the owner of a solar facility applied for a Clause 45th tax exemption and was denied by the assessors because the solar facility was not supplying energy to taxable property. Instead, it was supplying energy to City of Framingham property, which was not taxable. The 2 leading ATB cases regarding the Clause 45th exemption at that time were Forrestal Enterprises and the KTT case. In the KTT case, the ATB devised a 3-part test for eligibility for the Clause 45th exemption. The first prong required that the equipment be a solar or wind-powered system or device. The second part of the test required that the device or system be used as a primary or auxiliary power for the purpose of heating or otherwise supplying energy. And the third part of the test, which turned out to be critical in this case, is that the device had to supply energy needs of property taxable under Chapter 59. Because the device supplied the energy needs of non-taxable City of Framingham property, the ATB determined that United Salvage was not entitled to the Clause 45th exemption. After the decision was issued, United Salvage terminated its agreement with the city. The next case is Paya Verde Capital v. Assessors of West Bridgewater, another Appellate Tax Board case. The decision in this case was also issued on May 29, 2020. This case also relates to the Clause 45th exemption. Paya Verde Capital, the taxpayer, was a renewable energy generator and the owner of a solar PV system located in West Bridgewater. Paya Verde entered into an agreement to supply 100% of its electricity, or net metering credits, to property owned by the town of West Bridgewater. The credits were applied to 8 municipal buildings: the police, highway and water departments, town hall, council on aging facility, town library, and a school. None of these properties were assessed taxes by the town because the municipally owned properties were exempt from tax. When the taxpayer was issued a personal property tax bill for its solar array, it filed for an abatement, claiming an exemption under Clause 45th. Remember the 3-part test for exemption from the previous slides? A solar or wind-powered system or device, which is the primary or auxiliary power system for heating or otherwise supplying energy needs of taxable property. And also recall that in the previous case, United Salvage, that the ATB determined that United Salvage was not eligible for exemption because it was supplying energy for municipal property. Paya Verde, the taxpayer in this case, was also familiar with the ATB's three-part test, and it knew that it did not meet the third part of the test, supplying the energy needs of taxable property. So, it argued that because municipal properties are exempt from tax due to judicial decision or common law, and not by statute, the Clause 45th exemption is available to the taxpayer. The ATB did not agree and denied the exemption, saying it does not matter how the property is exempt, it's exempt. Empowering taxable property is a requirement for the Clause 45th exemption. An important thing to note about the ATB's Clause 45th decisions: none of these cases have been reviewed by the Appeals Court or the Supreme Judicial Court. The courts have the ultimate say in the interpretation of statutes, such as the Clause 45th exemption. So, we do not have the benefit of a court's interpretation of Clause 45th. We don't know if it would be the same as the ATB's. This is an area of the law that must still be regarded as unsettled until reviewed by the courts. Some in the assessing community are seeking a change in the law through legislative amendment. We'll have to wait and see what happens. RCN Beccacom versus Commissioner of Revenue. This appeal relates to the Commissioner of Revenue's central valuation of telephone personal property under General Law, Chapter 59, Section 39. Under that section, the taxpayer and/or the municipality can appeal the Commissioner's valuations to the ATB. In this case, taxpayer RCN challenged the Commissioner of Revenue's valuation, claiming the values placed on its property were substantially too high. Under Section 41 of Chapter 59, every telephone company owning personal property subject to central valuation by the Commissioner must submit a telephone form of list, Form 5941, not later than March 1st. By May 15th of each year, the Commissioner certifies values to the owners of the personal property and to the boards of assessors of the cities and towns where the personal property is located. When RCN filed its forms, the Commissioner informed RCN that its filings were deficient, that reporting the purchase price of the property in the 2010 bulk sale transaction did not satisfy the statutory filing requirements. RCN was told that the filing required original cost figures. RCN claimed the original cost of its centrally valued telephone personal property was the original cost to it, and not when property became part of the Commonwealth's telecommunications system. Where there is a bulk sale of assets, as in this case, RCN argued the original cost should be the purchase price attributed to the personal property which is centrally valued. However, RCN did then file some additional information with the Commissioner. It was still not enough. The Commissioner disagreed with RCN's definition of original cost. Original cost is cost at the time of installation. The Commissioner then established values based on the best available data and information furnished in fiscal year 11 by RCN's predecessor. The Commissioner valued RCN's property for fiscal year 12 at $154,828,900. For fiscal year 13 at $162,785,400, and for fiscal year 14 at $182,184,500. On appeal, the Commissioner claimed ATB lacked jurisdiction because RCN's required returns were insufficient. The ATB disagreed and held that it had jurisdiction to hear the appeals. On the merits of the appeal, the ATB rejected RCN's approach to value and held that RCN failed to show the value of its property was substantially lower than the Commissioner's valuation. In reaching its decision, the ATB held the Commissioner properly valued the property using a trended reproduction costs new, less depreciation methodology. The Commissioner's approach to value starts all companies at a common point, original costs new at time of installation. The approach is a standardized valuation system that is objective, transparent, and consistent. The next case is Roman Catholic Bishop of Springfield versus Assessors of the City of East Hampton. This was also an Appellate Tax Board case. This ATB case relates to the religious and charitable exemptions to local property tax. As part of a restructuring in 2010, 3 parishes in the diocese were merged into a new parish called Our Lady of the Valley. Some of the former churches were used for purposes other than worship sites. Such was the case with the subject property, the former Notre Dame Church, which was used for the storage of religious objects such as church pews, statues, crucifixes, vestments, and candelabras. The East Hampton assessors taxed the subject property for fiscal years 2015 through 2018 because the items stored in the building were not being used directly for religious worship and thereby not eligible for exemption under the Clause 11th religious exemption. The diocese claimed the property building was exempt under both Clause 3rd and 11th. General Law, Chapter 59, Section 5, Clause 3rd contains the charitable property tax exemption, and Clause 11th contains the house of worship religious tax exemption. The diocese relied on the case of Our Lady of La Salette, Incorporated versus Assessors of Attleboro, decided by the Supreme Judicial Court in 2017. That decision established a test of eligibility for the Clause 11th exemption, whether dominant use of property is connected with religious worship. The diocese timely filed its abatement applications each year, and also timely filed the Form 3ABC required for a charitable exemption. However, the diocese did not timely pay the taxes for fiscal year 15 and fiscal year 18, which is a requirement for Appellate Tax Board jurisdiction. As a result, the ATB held it had jurisdiction for fiscal year 16 and fiscal year 17, but not fiscal year 15 and fiscal year 18. The ATB held that the parcel was exempt under Clause 3rd because it was actively devoted by a charitable corporation to its charitable purposes. It also held that the parcel was exempt under Clause 11 in accordance with the test established in the La Salette case. The next case is Springfield Rescue Mission versus Assessors of Springfield. This Appellate Tax Board decision was issued on September 25, 2019. This case also involved the religious exemption, but it also involved an interesting determination of when the religious organization became owner of the subject property. The Springfield Rescue Mission is a religious organization which has operated in the Springfield area dating back to 1892. The mission had conducted religious services at its Bliss Street parcel in Springfield for many years, and during the entire period was deemed exempt from property taxes. Due to the MGM Casino project, the city approved a plan for redevelopment that included the mission's property. So, the mission agreed to swap its property on Bliss Street in return for another parcel, which would be acquired by the casino and renovated for the mission's use at no cost to the mission. Under the terms of the purchase and sale agreement, the parties agreed to sign and deliver their deeds to a third-party escrow agent to be held by the third party until the parcel was ready for occupancy by mission. At that time, the escrow agent would record the deeds at the Registry of Deeds. The deeds were executed and delivered to the escrow agent in December 2014. The renovation was completed and the deeds for both parcels were recorded at the Registry of Deeds in October 2015. The Springfield Assessors taxed Mission's new property fiscal year 2016 because Mission was not record owner on the July 1, 2015 eligibility date required for exemption. So, Mission filed an abatement application with the assessors, which was denied. Mission then appealed to the ATB. The ATB relied upon the case of Band v. Davis, 325 Mass 18, 1949, to decide that Mission was the owner on July 1st and satisfied the eligibility requirement of ownership on July 1st, 2015. The ATB said Band was precedent that the date of delivery of the deed to the escrow agent by the casino rep was the date of delivery of the deed to Mission. Getting past the July 1st ownership requirement, the ATB then reached the scope of the religious exemption question and whether it applied to the entire parcel. The ATB applied the dominant purpose test of the La Salette case and held the Clause 11th exemption covered the entire parcel, including classrooms, a learning center, kitchen, dormitories, donation center, laundry room, and offices. The ATB ordered an abatement and refund of $213,000 to the mission. The Springfield assessors have appealed this decision. We will have to wait and see if the court agrees that the Band case was correctly applied in this case to find that the mission was owner of the parcel as of July 1st, 2015. The next decision, also by the Appellate Tax Board, is Western Mass Electric Company versus Assessors of Springfield, issued on May 12, 2020. This case is the latest in line of utility cases overturning sole reliance on net book as a measure of utility property value. Net book value was formerly the presumptive valuation method due to utility properties being highly regulated. Back then, net book value neatly reflected the economic reality of time, that utilities were restricted in their ability to earn a return on investment and so should be valued accordingly. That is, a buyer of utility assets would not pay more than net book value for the purchase, since net book reflected the value of the regulated return on investment. But times changed and the valuation method needed to change with it. As a result, in 2019, the ATB and the Appeals Court and NSTAR Electric Company versus Assessors of Boston changed the way that utility property should be valued. Once assessors show that net book value is not dispositive of actual value, that special circumstances exist, valuation by net book is not required, and the burden shifts to the taxpayer to show the property was overvalued. Special circumstances are those that may induce a buyer of utility property to pay more than net book value. They include charges in DPU regulation. For example, the DPU's carryover rate basis rule no longer controls values in utility sales transactions. Instead, each utility transaction is judged individually. Another special circumstance is when the rate of return actually earned by the utility may exceed the return approved and allowed rate. There may also be potential for growth in the utilities business, which could induce a buyer to pay more than net book value. Following the reasoning in the NStar Electric Company case, the ATB upheld Assessors' blended assessment methodology, which combined net book value with replacement value, new less accumulated depreciation. It decided that net book value is not determinative of fair cash value as a standalone measure. The rising earnings from utility property after deregulation has undermined the persuasiveness of net book value. Net book methods set the value of utility ownership too low. New streams of income, new avenues of profitability meant a buyer would potentially pay more for utility property than net book value would indicate. But the ATB also declined to hold that replacement value, new less accumulated depreciation, should be the sole method of valuation as the assessor's expert had argued. And that concludes our presentation on recent property tax cases. Please see Part 2B for the next segment in What's New in Municipal Law.